Let me get the screen share here. And
Steven said this morning, did you see the Saturday Night Live? Like, of course. Have you seen the app that was up there?
and I didn't do that just to mess with Mark. I actually didn't check the app this week. But last week, I think it was Javon who asked the question about GameStop, and I gave an answer that I thought was fair but not complete. So I want to try and shed some more light on it. So I'm going to move off the video and just talk a little bit about what happened and what we see going on. But before I start with the slides, I just wanted to share a quote from Jim Chanos, who said, this is a euphoric market that's been going from new high to new high. Short sellers have been beaten up and left for dead, and we're still blaming them. So they've gotten vilified. And, you know, the reality is that shorts have been on both sides of the trade. So while some have gotten hurt, others have done quite well with the same things that the retail investor is. So I think it's not as much a Main Street versus Wall Street as it's being led to believe, but there is an element of it. So I think we've been in the most unusual social, economic, and political climate, with these all combining at once, and adding to that the advances in technology and social media, and the regulatory environment really hasn't kept up with it. And then you add to it low rates providing massive liquidity, but also fewer choices of where you can get returns. Throw in the inequality issues and the social divisiveness that we're going through, and you have a real witch's brew that we saw come to being last week. Then you had excessive risk taking in a lot of small cap stocks, and the less liquid stocks that had big short positions are easy to find. But what we've seen is an attack on this that's unlike anything we've seen. And that's actually led to significant imbalances and short-term price movements that have no basis on fundamentals, as we just saw from the Saturday Night Live skit. I wanted to just kind of walk you through, let me just go back here. This is since the beginning of the year, how GameStop has traded. And you can see fairly okay for the first bunch of days. And then you started to see some change starting to come. We'll fast forward to the 5 days. And this stopped as of Friday. So if I added 2 more days, you would have seen it back down, I think around $90 today, somewhere around there. So pretty significant change. So what's gone on? What happened? Well, we know that the hedge funds thought this was a company that was ripe for shorting due to the pandemic and also the internet and the access to games. Based on the size of the bets, it became clear that the short interests have gone beyond what was easily covered. But what's really important, and what's lost in all the noise about Wall Street bets and all that, is the quality of the research that was put in to start this transaction going, which was really well thought out Wall Street quality research theses being written up on why the shorts were vulnerable. And then you had the movement of the masses, which created this big groundswell. And the worse it got for the shorts, the worse it became for everyone else. And I think what happened is, not only did you have to have requirements to borrow money to close out the shorts, but you were seeing forced selling in some of the winners for the last year, which actually changed the dynamic in the short term. Again, none of this is based on the fundamentals. So when you step back and think about what's going on, you had some technical activity in the markets. The hedge funds had to fight to execute their positions. Other institutions saw this as an opportunity to jump in and take advantage of weak hands. And that's where the way Wall Street works. That's the auction market. But this is not a fundamental change. But another thing that came in is the limiting of trading, which everything's fine when the stock market works until you're told you can't buy and sell things the way you want to do that. And then it creates panic. And I think that's what we saw. And it wasn't just GameStop, as you know. AMC has a similar chart for the year to date, and then for the 5 day. And if we carried it forward, again, same with BlackBerry and others. So where do we go from here? I expect there'll be rule changes to shorting. It's been talked about forever. It's coming. I believe that there'll be some significant changes coming there. Whether they go with transaction taxes to curtail some of the short-term speculation or not, TBD. Taxing short-term gains at an even higher rate that's being proposed is something that would not be a shock because of stability issues in the system. Requiring platforms to hold more capital is another issue that I think is front and center, and how that's managed is going to be something that we have to really keep an eye on. And then I think services like Wall Street Bets are they giving advice, or are they offering an inducement? And therefore, should they be subject to different regulatory oversight and advertising requirements and the like? How does that play out? I think is something that we're going to have to see move. But I think one of the more fascinating things that isn't being talked about is how Ray Dalio and the guys at D.E. Shaw, Citadel, Renaissance will adjust, or have already adjusted their AI programs to scrape Wall Street Bets, the Wall Street Bets for Bitcoin and other services, incorporate that into their AI, will bring it in right into their investment process, and will be faster in executing than any retail investor can. And they'll be leading up and leading down and benefiting from it in a pretty significant way, which actually would be all legal. So I think that there'll be adjustments made to the system that'll make this more difficult. And if we just step back, and this is what I was highlighting last week, what we saw back in the 90s was day trading was as popular then as it was the last week or so, and it was popular for a longer period of time. And what happened is that Wall Street adjusts to it. The hedge funds, the other institutional investors adjust to that. They make adjustments to their process, and then they take the upper hand again. So I think that's a big issue. I think the other issue, does a platform take a loss so big that it goes under, or it changes the way they approach clients? And this is not something that's pure speculation. If you recall back in the financial bubbles that we had, either in the late 80s or the early 90s, Charles Schwab got caught where they had a short position for a Asian client. I think they lost between $100 and $400 million on the trade. So this is something that they could handle that, but can all these new platforms handle that? Don't know. How should investors think about this with regards to the future? And I think it depends on what type of investor you are. And understanding who you are and how you're going to invest is going to be very important, managing a very difficult environment going forward. I also think trading restrictions will lead to a loss of confidence in clients. It depends on how fast they get back to normal operations. But think about what happened for Robinhood. Their clearing company came out the other night and said, we need $3 billion more capital. That's hard for companies that are growing at the rate these guys are growing. They negotiated it back down to 700. And then lo and behold, last night they had 2.4 billion to shore up their finances. That sounds like they were given a grant to buy time to raise more money to me, not that everything was fine with where their financial position was before. So I think this is going to get a lot of attention from the regulators. And keep in mind that the new regulator for the SEC is going to be, if he gets approved, Gensler, who comes from the commodities side. And after what went on with silver yesterday and today, how's he going to regard this? I think it's going to be something that's going to be fascinating to see. So what's our view? We've seen some of this before, but not all of it. Long-term investors, their biggest concerns are fundamentals, not the short-term trading and speculation. It matters, but it matters less the longer you have your view. I think security prices will return to valuations that reflect their real value, and we're seeing that in the last couple of days with some of these high-flying stocks. And let's keep in mind that the people, everyone's talking about the students that paid off their debt and all that because they took their tuition and bought all these stocks. Remember that when it was up in the 400s for GameStop, there were buyers as well as sellers, and not everyone made out quite well in this. So we're going to see a lot of problems coming out of this for the people that really got hurt. And while we're talking about protecting the individual investor, and this is again about the populist movement and going against the man and Wall Street and all that, keep in mind who hedge funds manage money for. They manage money for foundations, endowments, and pension plans. So, as well as families. So at the end of the day, the people getting hurt are next door neighbors. So we have to be mindful of, it's not an attack on these rich hedge fund guys only. It's the customers that and the clients that are in their funds and the beneficiaries of their investments that need to be kept in mind. I think, for us as a long-term investor, earnings, cash flows, and moats matter. What happens in the near term, it impacts us. Don't get me wrong. When the selling started going against the names that have performed well, you got to keep an eye on that. Charlie Munger said that more money has been lost to the two L's. It used to be three, but I don't think it's appropriate for today. Leverage and liquor than most people realize. And you only find out about the leverage being a problem when it becomes a problem. So keep that in mind. Over-levered environments tend to end badly. Short-term volatility and exaggerated movements are going to hurt confidence and distort valuations. But as I mentioned last week, I think we have a generation that's coming out of the last 20 years of the financial crises, the wars that we've had going on, and then this last financial crisis, that the pandemic, that's going to damage their confidence and create more of I think, a depression type generation, even though a lot of people are talking about how much money's been made in the last couple of weeks. I think there's a lot of changes coming in regulations and how people approach it, but I don't think what matters will change as much as everyone thinks it will. And I think as we've been through this is a highly unusual couple-week period, following a highly unusual 11-month period. So I think there's more unusual stuff coming, but at the end, you go back to the things that have worked for a long time. And that's the basics of investing that will matter over the longer term. You have to factor in the technology changes that we've talked about throughout the last year or so on these calls. But I think this is what's going to matter going forward. And I think there'll be a lot of money lost in this as well as made. And it's not just the hedge funds, but really the retail investor are going to come out on the wrong side of these trades as much as anybody else. So that's my 2 cents worth of a nickel's advice. I'll let you guys take it from here, because I think there's so much important information that this group has to offer in this and different perspectives that that's what makes this community so great. So Mark, with that, I'll turn it back to you, and hopefully we get a lively discussion out of this one.
Absolutely. So who's made a lot of money or lost a lot of money on this? Or who's got an opinion?
I saw one number, Mark, before you start, that I think hedge funds had lost on shorts about 70 billion this year already, which, I don't know, it seems like in the overall scheme of things, not that big a number with the numbers we're throwing out, but if it's your money, it matters. It's a big number that way. So,
hey, Stephen, this is Jim Flipkowski. I was wondering, I was thinking about this the other day as I was swimming. What's the benefit to the economy of short selling? I really couldn't come up with any justifiable reason other than it's a roulette bet at the casino.
I'm glad you raised that, because it's something I should have mentioned. But in my past, I worked for Mellon Bank and was the vice chairman at Standish and Wood, a bond shop. And I joined there in October of 2001. In May of 2001, at the leadership conference in Turnberry Isle, Florida, Mellon decided to have the leading company, one of the hottest stocks on Wall Street, come and speak about the new way companies should be managed. And once we were done hearing from the guys at Enron, and I moved to Standish, I found out that we owned Enron, WorldCom, and Tyco in our portfolios. So the answer to your question, Jim, is what they've done through shorting over the years. The shorts have uncovered fraud, they've uncovered malfeasance by companies, and they've uncovered just bad business practices where the market's gotten it wrong. So I think there is value to it, but I don't think there's value to it without having a stake in the game. So naked shorting and things like that is more speculation. Some of this was done with real value, and I think that's been lost in this discussion.
It's interesting, your comment just now, though, credits the analysis of the short sellers greater than the analysis of the asset managers, who didn't have the same level of insight or criticism of the value of Enron stock as the short seller did. So it's really, you've just really criticized the individuals, right? For, because, you know, a money manager can say, gee, on my analysis, Enron is a bad stock. I'm selling it. I'm not going to hold it.
Yeah.
So I'm not sure I follow really the value that you just ascribed to a handful of people, and not in a way, you know, it's a backdoor criticism, if you will, of the people who owned Enron and the other stocks that were basically frauds.
Well, you're right on that, Jim. There is, for each side of the discussion, you're going to have a very valid argument for and against. I think what it comes down to is the quality of the research done by who's doing it, right? And that's what's so hard for investors, is to figure out who are the guys who really understand what they're owning and who don't. And I think you can have it on both sides. The guys who were doing the research on GameStop, both sides it was valid, right? But what happens is the position sizing. They could have had the right thesis, but the wrong position sizing, and that's what you saw with GameStop. Is their short interest was way too high, and at that point, your risk management capabilities. It doesn't matter if you're right. If you get in a short squeeze, you're going to be wrong from a market perspective, but you'll have the Pyrrhic victory of being right for your thesis, but you'll only find that out after you've lost all your money. So you're right on both sides of it, but I don't think it changes the view that some people do really good research and some people don't, and some people are lemmings, and that's what makes an auction market.
I just wanted to make a quick comment. This is Anand from Bar Capital. I would very forcefully defend short sellers. I don't agree with that point of view at all. You know, if the short sellers have improper knowledge about a company and are breaking securities laws, they should be prosecuted and caught, and all of the things that somebody going long on a stock would be under if they had violated securities law. But short selling is like telling people, hey, you're all overweight and you need to trim down. It's telling the truth. And if you profit for it, and if you build large positions, and if you're advocating for that, there's nothing wrong with it. It's a critical part of the markets. I used to work at Morgan Stanley's wealth management division, designing and executing market risk algorithms. And you need short sellers a lot of times to come into a stock like GameStop, so that people who are just listening to the headlines and are buying into a overly valued stock at the wrong time don't keep buying it at higher levels. And that cycle doesn't just keep going perpetually and building a bubble like the .com bubble. And, you know, I wish there was more people taking the courage to short sell more actively and taking the time and interest to understand it.
I'd like to.
I like this. Just one second, Greg. There's hold your thought. Don't lose it. Will Walsh, you're new to the group and you've had 25 plus years of trading. What's your point of view?
Yeah, I mean, I agree with Aman. I think it's a necessary part of the market for sure. I mean, as Mark said, I traded for 20 plus years, multiple sectors, and it's, you know, I think it's just part of the, you know, of the market deciding what's good and what's bad. So I completely agree with his point of view. You know, I mean, ultimately, long-term investors like the initial discussion, like it wins out over 10 years, right, 15 years. But I think the short seller has its place for sure.
I mean, in one sentence, doesn't it just make the market more efficient?
Absolutely,
yes.
Giving signals.
For sure.
Is it fair then the short squeeze that happened by the retail investors? If it's an open market and everybody has the opportunity to do what they want, then I think to defend short selling, which I'm not opposed to, means I think by its very nature, you have to defend the actions that went on in the market by the retail investors.
I don't think that.
I'd like to add a different point as well, from a higher level perspective. You could use short selling to balance your portfolio, like to hedge against like your business, for example. So that's like I think that's like a fundamental reason of why, you know, puts and short selling exist. I think the issue with GameStop, it was the sharpness of the movement and obviously breaking businesses at the same time. So it became more of a fight really than just like regular shorting.
And Greg, you want to say something?
Yeah, so I wanted to add, so I think the points that Anand and the last gentleman who spoke, I'm sorry, I didn't catch your name there. But it's a liquidity provision into the market, right? And if you take it out, then it's going to be missing. The other one is you're not going to have an effective convertible bond or option market without the ability to cover the deltas of those instruments. So this has, and at the same time, you had the options market playing a fundamental role in what happened in GameStop as well. So I think there's several layers of analysis that need to take place. I think one that we haven't mentioned is, why did the short interest get to such high levels? So they're lending and relending, so lending cubed or lending quadrupled, if you may, of the same stock over and over also contributed to this. So I think there's things to make better. I'd love to speculate a little bit with Stephen and anybody else who'd like to, what the potential fixes for the short selling could be, because I run a long short equity fund, and whether that is going to impact my ability to do business in the future. Other elements to look at is, Stephen, you spoke about the .com. What ended up coming out of the .com were a lot of things, right? I mean, we ended up with the markets we have today because of .com. We're fragmented, there's no price discovery in single places anymore. Price discovery is taking places at the conventional places, which were the New York Stock Exchange and NASDAQ, but also in dark pools, in alternative exchanges, off board. So there's a lot more fragmentation of markets. Reg FD, if I'm not confused, fair disclosure came out of things that happened during .com. And that addresses a little bit of who has better information than others in terms of making decisions of what you want to do. And a lot of rules that were put in place to theoretically protect small investors from actually doing what they just did. So the reason we ended up here is there's a lot of reasons, and the question is, given the Uberization or democratization of finance and everything that's going on, how much of that should be impact? I think the collusion should be collusion on buying a name like GameStop should be examined, and whether the message boards or things actually constitute investment advice or not. But you should also examine the collusion on the other side, right? Because when people who know the industry start figuring out who were holding those large short positions theoretically on the fundamental basis, you can see a thread there, right? These people know each other. They're cross-funded by each other. There's a lot of things going on there as well. Why am I worried? Because let me be perfectly honest. I know what GameStop is because there's one in my mall, in my regional strip mall, but didn't know the business well. I went back and I looked at it because I said, okay, let me see if this were something that is in the pond that I fish in to do longs and shorts, would I have actually gone short this thing? And my preliminary analysis says, yeah, look, it kind of looked like a dying business. So we're all subject to risks coming from this thing, and I think it's going to be a long tail of analysis to figure out how to make things more efficient. I don't think it starts though by banning short selling.
May I ask a question here? First, everyone, thank you for your thoughts. I happen to agree with what you're saying about short selling being an important mechanism for efficiency in the market. This morning, I don't know who else subscribes to Andrew Ross Sorkin's Deal Book. I find him to be quite a good thinker, prolific writer. Not sure if I always agree with what he says, but certainly he's provocative. This morning, if I may just read what he sent us, he offers 6 prescriptions, as it were, to try to get a better handle on short selling so it might not be so deleterious. And so he says a transaction tax on trades value, even of 0.1%, might reduce its attractiveness. I'd love to hear people's comments. Force hedge funds to disclose short selling positions. I think that would be a real disaster. I think most could agree to that. And private meetings between investors and companies. I get that concept. Change how people qualify to access private investments. Now, I thought that was interesting because what he's proposing here is that in order to invest in, let's say, the more exotic, complicated, ostensibly or theoretically more risky strategies, such as hedge funds, private equity, VC, what have you, that they should take a financial literacy test. I like that idea. I really do. End payment for order flow. Where the likes of, Citadel Securities, might pay for order flow from brokerages such as Robinhood. And then bring back the Buffett rule. Apparently, this was an Obama-era proposal that effectively imposed a 30% income tax on anyone who earns more than $1 million. I don't know about that. In any case, if you get his emails, you can see these 6 points. Some, seem interesting. Others, I'm not so sure about. If anyone would like to comment on any of these, happy to repeat it, or otherwise, again, Andrew Ross Sorkin, Deal Book Today.
Can you put it in the chat, just if you don't mind?
Yeah,
I read that article, John. What was interesting, so each of those proposals had the pros, but they also had a con section.
Yeah, of course. I'm going to copy this link and put it in the chat section.
Did I hear you say that retail investors should take a financial literacy test?
Yes, that's what he proposed.
Yeah,
I think it's a great idea.
That'll never happen. Good luck. If that happens, you're just going to create another GameStop short squeeze, because then you're just fueling flames to the fire of a lot of these retail investors in the first place, which is they feel like they're not heard, they feel like they're disenfranchised, and all you're doing is making that worse. That'll never happen.
Absolutely. Yeah, I agree. It's an interesting cultural study, really. I mean, it's very difficult to unwind how much of this is a small group of people trying to enrich themselves by bandwagoning, or whether it's really this, ability to, or this attempt to stick it to the man, I think, as Stephen said. I have a sophomore at college, and I actually see some of the banking statements, and one of the examples of how this has spread itself into the tradosphere in terms of retail is that I now have a sophomore in college who's buying Dogecoin because Elon Musk put out a tweet about how meme investing is a good idea, right? So on the one hand, he's a pretty responsible kid and he didn't go crazy, but on the other hand, the ripple effect for this is very difficult to quantify. I mean, I don't think we even have any idea of the track, per Denise's comments that she's talking about, the trend here of how this is going to unwind and further kind of get its tentacles around the retail investor psyche. I think it's interesting on the one hand, but a little bit scary on the other.
Hey, Stephen, just on that point of retail and the whole Reddit, this is Rob here. Was there any notable organizational differences here? Meaning, was it like a specialty advisor firm advising a few individuals that basically it was Pied Piper? Anything sort of different this go around than sort of before?
Well, back in there was, and we didn't have, the internet was being developed back in the 90s. So the ability to send information around is very different today. The ability to trade much faster on an institutional level is very different. And the ability to get the masses behind an idea is, I think, the most significant difference now. And there's no cost to doing any of the transactions. At least back in the 90s, Schwab had some transaction costs back then. So there, you had to actually, you couldn't just jump in, as it were. So I think the differences of liquidity right now is never been higher. So the cost of money is zero. The margins were high then, they're high now. But I just think this is and I think the backdrop, both as I started with, socially, politically, and economically, is so different now that when you throw it all together, it creates a very different environment. And so I think those things are all different, but I think at the end of the day, you're going to have people buying and selling with different levels of information and different levels of knowledge that are either going to, be very lucky or be very successful or not.
Just as a thought there, I agree that I think on the other side, the short sellers and the hedge funds, are prepping for the next go around and getting smart advice. But likewise, I think sort of the the core leadership behind this are probably well advised. Are going to be well advised because there is being money made, and if it's through financial advisors, wealth managers, or other things, I just think there's money to be made. They're going to follow that as well. And this is not maybe a one-trick pony. I think I agree. There's going to be some losses as a whole, but I think there's going to be some fundamental movement here. I mean, you're hearing things about silver. You're hearing things about other areas that are being that are being targeted now as well.
I think the other thing that's going on, and Stephen, you touched on this, is the fragmentation that's occurring in our world today because of technology. Whether it's journalism, everyone's a journalist, everyone's an audience. To this, I think the point you made particularly interesting was how Citadel and other hedge funds have already modified their approach to scrape data and information and act on that, which tells you that it's like a casino. The casino is always going to win. It'll be a back and forth, and I think only time will tell, because as much as Citadel and other hedge funds will look at Reddit or Wall Street Bets or something to scrape information, that information will now find its place in other sources that Citadel will be running to catch up to and scrape that as well, because technology will permit that, right? It will permit continued evolution of this fragmentation. And so until the federal government steps in with some sort of regulation, which, by the way, I'm not sure I'm not sure where the government stands on this right now with, Elizabeth Warren and her opinions, and AOC thought this was fantastic. So I think you've got a divisive government right now that is really lacks a clear, dependable direction. And so I think technology is going to continue to be somewhat of a turbulent current underlying all of this going forward.
I liked hearing the comment earlier, and I always think about this, is Ray Dalio and a bunch of billionaires are going to create, all right, well, if our previous algorithm doesn't work, let's create a market sentiment algorithm that reads Reddit. By the way, that already exists. That's not like Ray Dalio is not reinventing the wheel. That does exist. Someone's already building that. I would also say that, sorry, Stephen, you want to say something?
I was just going to say, Jonah, I know it already exists because they've been doing it for years. They just added Reddit into it, or they'll add anyone they think is moving stocks, and they'll be, and it won't take them very long, and they'll be in front of them. So
no, I'm telling you,
and they don't always get it right.
I'm telling you, it won't work. It won't work. You know why? Those market sentiment algorithms only work if people don't know they exist, and now they know they exist. I mean, you haven't met, for example, a sophomore in college. We know how algorithms work because that's how you get big on YouTube or Twitch. They all run on algorithms, market sentiment algorithms. And so what happens is, just like on YouTube, is people my age know how to game the algorithm. So if I know that you're following me because of Bitcoin, I'm going to act like I'm now increasing Dogecoin. And then I'm going to create a sub post that they haven't analyzed yet, or on a different platform, where I'm actually going to give my real information. I'm going to scam the system because algorithms don't work in a market sentiment paradigm. I mean, one day it will. There'll be an AI that does understand it. But algorithms are not like, they don't comprehend human emotion. They comprehend patterns. And if you understand that a pattern exists, there is no pattern. It defeats the purpose of the algorithm. So what you're going to have is essentially a new class of investors called the retail hero. You see it in Elon Musk, you see it in Chamath, you see it in a couple other people. And the only way you're going to beat the market sentiment is if the short sellers, each one of them, have retail heroes, meaning people that create social media around their funds or around their hedge funds that explain why they're doing what they're doing, and that retail investors feel like they're a part of their group. Because if they don't, all they're going to do is alienate that audience. And the reality is retail investors are a lot more powerful because they can control the market and they're irrational. And you can't fight irrationality with logic. It doesn't work. Irrationality always wins. So the only way to fight irrationalism is to also be irrational. It's the only way you can fight that. It's like if you had a bunch of monkeys and a human. Like, the monkeys are gonna kill you. they're stronger than you, even if they don't have the intelligence that you do. So that's going to happen. And then I think a lot of people in Wall Street aren't following the YouTube creators that actually do have real knowledge in the market. I bet most of you don't know the Twitch streamer by the name of The Stock Guy. He has over 9,000 people a day watching his live streams on Twitch. And all he does is talk with people my age about what he's trading and why he's trading it. These people are not that dumb. There are a lot of followers that are dumb, but the people who run Wall Street Bets and the people who run the major stock social media side on the retail side are actually industry veterans who've decided to be the retail hero, because now they're not only earning on their trades and they can move the market, but now they're also earning on advertising and social media dollars. So I think that's something you really need to look at, because you're going to see a lot more retail heroes after this incident, 100%.
I just remind everyone, though, that how an auction market works, which is for every buyer, there's a seller. And what we are seeing right now, and what we've seen forever, is you had a compressed exuberance in a handful of names that were chased up. But remember, at 400 and whatever dollars GameStop got to, somebody was buying it thinking it was going up before it took the next turn down. So the market cleanses itself because of that process. And, you know, that is the market, right? It's everyone bringing their, whether it's through Reddit or through Renaissance, it doesn't really matter. It's somebody buying and somebody selling with a view of value. So value wins out over time, and it's just a question of how are you playing it. So, you know, I think there are real issues that are going to evolve. I think all these social things that are being raised are the right ones, but at the end of the day, somebody's buying and somebody's selling, and they're betting on the opposite impact. So I think that's what we're going to see over the long run. In the short term, the market valuations doesn't matter as much. In the long term, it does. And that's where, you know, people will be playing in different elements of the market as well. That's why there's shorts and longs.
I'm just thinking, would it be useful? I'm just from the regulatory. I just happened from my law school friends. Some of them are in the SEC. And one was a family office head who just went over, actually, on the Zoe, you guys, he's looking after, not looking at, one of the people looking at the cryptocurrencies. Maybe we could get some of those views in here. I don't want them to overtake us, but at least as a part two.
Yeah, I think.
Please go.
Mark, what I have heard though just this morning is, and I know they always do this, the hedge fund industry has already started mounting their defense, both from dealing with Congress, dealing with the press. They're going to go back and say, we've done a lot of good, and they have. And the money lost is not, you know, yes, some of it's the hedge fund guys, but that's we're vilifying. But the reality is the good that they've done over time far outweighs the bad activities of any investors. And it's same in any business. So I think that, you know, we're going to see that you'll have changes coming. I wouldn't be surprised if they put the uptick rule or make amendments to things like that to make changes to make the system better. Often they have unintended consequences, as Greg highlighted before. Reg FD has some positives and negatives. It's not all positive. So I think we just have to kind of keep, you know, the market will keep evolving, but I can tell you the defense is already starting for everybody. You know, Robinhood has to have their defense. Are they a viable entity if they have to keep raising capital, or is this enough capital or not? You know, nobody knows that yet. So I think there's a lot of uncertainty and a lot of questions that'll be answered before too long in some cases, and down the road in others.
By the way, another retail, I'm calling them retail heroes, so I hope that name sticks, because I think that's what they should be called, because they're making content related to retail investing where they control the market. The Stock Guy is one on Twitch, another one you should watch, and not because they're intelligent enough. You need to understand what these retail people are listening to. If you want to understand the market, you have to understand, you know, retail investors don't watch CNBC, CNN, and Fox. They're not watching that. They don't care. They think it's all fake news, so they're not going to watch it. So they don't care about listening to Jim Cramer. No one my age is going to listen to Jim Cramer. They're going on YouTube and Twitch, and they're listening to these other guys. So if you want to understand people my age or people who are not experienced investors, there's another YouTube channel called Dumb Money Live. They literally get 40,000 people live on their stream where they talk about really dumb stock plays that make no logical sense, but they're basically manipulating the market. But I would assume most people on Wall Street have no idea or have even heard about this channel because they're not actually doing the research to learn about these irrational investors. It's really important to watch what they're watching to understand what they're thinking.
Let me point something out.
Just Greg, hold that thought. Could we bring one or two of them in to share their perspective?
They've just made a lot of money from the market, including on GameStop, and they're in very high demand. So I will highly doubt that I can get them in here, but I do know people who work with them.
Even a spiritual cousin of them. But go ahead.
Yeah.
I
can bring you just some 10-year-old. He can give you the same advice.
So my analysis of what you're presenting us, Jonah, is no different than what the investment industry does now. I mean, you've articulated business models and investment process. Whether that process is sound and whether the model is sound, we'll see, right? A lot of the other things that you've mentioned, by the way, regulation makes it illegal for the conventional Wall Street and investment world to actually do that. And I'm sure somebody's going to look at it from the point of view of the retail heroes or whatever it's called. Look, this is disruption at its best, right? Mutual funds were created so that people could access investing. It seems from what you're saying that given the current standards, they have failed at communicating their process. They have failed at communicating
100%.
their objectives to people. And therefore people are going to alternatives which they feel are articulating their investment needs or something else much more adequately than what's out there. That's fair game. That's disruption, right?
So what I'm saying, just so you know, because I agree with you, I'll put it in the context of video games, because I do see the Wall Street much like a game, even though you probably shouldn't, but it is like a game. In video games, when there's a new patch, we call it patch notes, meaning a new update, we have something called the meta. A meta in a game is basically the process in which the game is played to win the game. Every 3 months in a video game, the meta changes. And so everyone who's the top player in the scene has to change up how they're playing the game in order to stay on top. The stock market's no different. It just doesn't occur every 3 months. It occurs maybe every 10 years. And the process as of now is officially changing to a new meta. And I think the current meta of this game is understanding how retail heroes are controlling the retail investor market so you can make better trades, even if they're irrational. Because the market is going to be irrational for a while. Because, I mean, think about it. We're living in our homes. We haven't left the house. We've been around a coronavirus pandemic. Iran's getting nukes. The whole world feels like it's on fire. And the average person isn't looking at this rationally. They're thinking, well, what is money even worth anyway? I might as well keep GameStop because at least it's funny. So you just have to understand that these people feel like they have no hope. So they're going to trade irrationally, at least not the bottom level retail.
What happens when GameStop quarter after quarter keeps posting losses and you realize you're holding something that
they'll lose. No, I'm not saying it's good. I'm not for or against GameStop. I abstained. I did make some money from AMC just because I thought it was funny to invest in movie theaters. I thought that was ironic, but I left at a good position. My thought is a lot of people are going to lose money on the retail side. But because they're irrational, they're not going to blame themselves. They're going to blame people who are running the market. And they'll go after another company. They'll go after another company and another company until someone gets hurt. That's what's going to happen.
I've just got a question for kind of everybody. I mean, just kind of thinking out loud. Is there an opportunity for a company like GameStop to reinvent themselves here, raise equity in the capital markets at this kind of, heightened, period of time where they've got all this attention, all this, liquidity in their float? And then from there, do something like a Netflix and actually be a content creator, right? They've got so much data and understanding around what is actually working. Yes, they're on the retail side and they're brick and mortar, and that's obviously the wrong model. But can they switch here, pivot, and actually do something and really, kind of fly from here further?
Pieces around the Chewy guy coming in.
Very unlikely. Very unlikely. That's a gaming question because that's not a matter like don't they have to wait 3 months to even exercise this new capital? Am I correct in that? I don't know what the rules are on that.
No. I mean, Elon Musk faced with a a raise in his stock price like that would have raised capital yesterday.
Right. Well,
No. I think, Joe, your question is really good, and that's part of the analysis that the short sellers and the long buyers have made. And I think Jonah's correct. I think where he's going is game development will not work for GameStop the way that content creation worked for Netflix.
right. Well, there's a reason it doesn't work. It would have worked 5 years ago. They would be probably multi-billion-dollar. I actually think they'd be a great. I'm only giving this advice, by the way, because our fund's not going to touch GameStop. So I can share this because we do look at the GameStop, the gaming stock market. GameStop is too little too late. The problem is, even if let's say they actually could raise and they could turn themselves around, unless they get bought out by Microsoft, which I know it was a thought, Microsoft owns that market when it comes to cloud gaming subscription service. They've already bought the market. And in order to, the amount of money they have to raise, they don't own, as far as I know, they don't own server farms like Amazon or Microsoft to actually host those games. Like that's a multi-billion-dollar investment. They can't do that. And then, so the only option is, okay, well, can I sell these things digitally? They already sell it digitally, but Amazon and Walmart already sell me digital keys at a discounted price. On Amazon, I have Twitch Prime and I have Microsoft Game Pass Prime where I get a discount for buying their digital keys. And so, okay, well, you lose there. And so if I'm GameStop, or what about selling discount digital keys internationally? Well, the EU just imposed laws against that because they believe that's not fair market trade. So they can't do that. So what are you left with? Well, maybe you could survive in esports, but there's not enough money there. So you're going to probably build esports related content out of your stores. Maybe Microsoft will buy you, but they're going to buy you at a very big discount because they don't really need you. So that's a possibility. They could create, memorabilia shops, but those don't drive in enough revenue to justify anything. So the bottom line is, I don't think it's going to go anywhere.
Let me just ask, Will, can I just to your question, Joe? Will, do they have an ATM on the shelf?
Oh, I do not know if they have an ATM on the shelf.
Because if they did, couldn't they have been selling all the way along, and we'll only find out on the quarterly report?
Yeah, if it's in place, but I don't know the answer to that question. I don't know if it's.
Because if anyone doesn't know, at the market issuance allows the issuer to take advantage of these times, and then they issue into this market. So if they're really smart, they can do a big block, to your point, Greg, but they may be already buying in or selling into it.
Hey, Joe, Rob, just quick question on that thesis you brought up. And didn't AMC raise like over $1 billion in the last recently, correct? And I think Jonah made mention of that maybe individually. And I guess the CEO spoke at the thing I shared to you and Mark at the Saudi investors event last week. So, it seems a combination of both. There was some significant long-term money that made an investment in this. And I guess they were betting on sort of a return to the new normal or the hybrid normal that, they were going to see some good traction back at the theaters there. But
that's a fair comment, but they did that capital raise at much lower valuations. And the other point that's been raised on a potential capital raise by the GameStop management is, can they act as fiduciaries, actually knowing what the business can deliver, right? They could be subject to lawsuits for selling stock at $400, knowingly having a business that was failing. So it's not that easy a proposition, and there's risk associated with doing things like that.
Yeah, I almost just assume that they would have to come out with some kind of new strategic direction or some kind of new plan that they go out to investors and say, hey, we're going to be, incubating or building this new kind of business that's, integrated with our other channels and our other business, right? And so if it is content creation in some way, shape, or form, and hiring the right team and executives to kind of, create those games, I don't know if they also have the right market or the right sales channels to distribute from there as well and be a little bit more streamlined. And are investors willing to take a chance and invest in that? I don't know.
Well,
they do anticipate theatrical coming back. I mean, Europe hasn't even deviated from the way they purchase content from the US. They still base it on theatrical.
And China just overtook the US. But I think to your point, Joe, they may not have the right DNA. And to Greg's point, I don't know about the I just know that everybody should be aware that these ATMs, as these things spike, the companies could take advantage of them to a point. But they'd have to actually have a use of capital, ROI plans, and all the rest. I'm not sure they have it here.
I actually think
If their
AMC is a better
management could have
chance than
anticipated
GameStop.
this, Mark, if their management could have anticipated what happened in the last week, then they should, Joe, whatever they say next, you should buy it, because there's no way they could have figured out what was coming. There's no way.
But that's why every company should have an ATM if you're in the public markets, as some people know, just for that reason, because things will happen.
Does anyone know if management sold out any of their shares in the run-up?
We'll only know when they have to file.
Yeah.
Well,
It's
that would
too recent, so
three to
there's
five.
more layers of this to come out that we'll be able to examine.
Well, I suspect the journalistic community is on top of that. We can look at the filings. I mean, this is definitely not what we have to be aware. I'm sort of wanting us all to be aware of it. I don't know if we're all players in it per se. But Jonah's that was great, good points, Jonah. I'd love to hear, to Jim's point, that is a cultural phenomenon here. And like my daughter, I was saying at the very beginning, is selling her using her babysitting money. We give her 20% of it to play, and she bought AMC theaters and gave me a whole 10-minute spiel on it for the one share.
I thought I did it out of purely, first of all, then you should understand my age. I did it for the meme. My buddies did it and they were having fun with it. And I was in a group and I said, I'll buy some shares just to be in on the fun, and we'll have a couple beers and talk about it. But I actually do think AMC has a better chance of survival than GameStop. I think GameStop could have been a massive, massive player, and it's the blockbuster story is what GameStop is, the blockbuster story. I don't see, I'm not saying it's impossible. Through miracle they could, and I could be totally wrong. I just don't see them from a gaming perspective taking back market share. Also, you talk about market sentiment. As a young boy, I sold back my games at GameStop for 25 cents when I bought them for 60. And I have to tell you, I won't feel so bad when they go out of business, because thousands to millions of kids my age had the same issue, where they resold at such a low price that they have actual animosity towards the company. And the only reason they're buying in is just to make fun of Wall Street, not because they like GameStop. And the minute that joke is over, they'll all pull out.
You left out the part, Jonah, about how they then sell them for $40 after they bought.
Right.
Yeah.
That business model alone, I think, destroyed their business, because it pissed off so many people that I think no one, even if they had a game service, no one would pay for it, because they just feel like they're getting cheated again. I think they should have never done that business, just totally avoided that business, or at least offer better prices. AMC has a chance, mainly because of their properties, right? Like, forget about movie theaters as like going to see movies, but the properties are big enough that they're really, miniature theme parks in their own right. And when we all want to go back to reality, we still want to meet each other. And I still think there is a part of America that likes to go to movie theaters as a date, but maybe not to watch the movies, maybe to go to a VR arcade, or to go to a really great bar that has the biggest TV in the world to watch the MMA fight.
Well, it's interesting you say that, Jonah, because the son of the Regal Empire actually set up a chain that's exactly as you described about 3 years ago. He's got about 10 theaters and growing. Kevin Mitchell.
Yeah, I think they're interesting as little
bowling alleys, games, restaurants, like it's a whole world in one.
That part makes sense to me, especially because they're in a lot of middle class neighborhoods where, if they don't want to go to the mall, they can go to the movie theater and go, do something fun with their kids. That makes sense. I don't think those will go away, but maybe showing movies is not their revenue driver. Maybe it's something else.
And Mark, the other thing to that on the properties is that, in this COVID recovery, this is kind of Wild West. I think there's all kinds of deals being cut with the real estate landlords, from the malls to the strip malls that GameStop may be in, but more so like the AMCs are in, where there's restructuring, there's landlords taking equity, there's all kind of concessions for the landlord's interest of keeping these either presence or anchor tenants sort of in there. So I mean, that's the other kind of, from this discussion, is interesting, from the technology share and the styles, that was cool, but then the real estate side is very interesting in terms of Wild West. As an observation.
I also wouldn't discount that theatrical is going to come back stronger than ever. People are going to go see movies. There's not enough revenue currently in the on-demand releases like they did with Mulan and all that stuff. And there's a lot of competition in the streaming world. So I believe that theatrical will come back stronger than ever, and I believe that the studio. I hope not to be wrong. I think that one of the studios, probably Disney, will buy the theater chains for A Song and a Dance, because the Paramount decree went out the window recently, which now means that the studios can have a monopoly on the theaters, which is what they have in the streamers.
I definitely see your point, and I'll tell you, if Disney keeps up this payment plan where you have to pay a premium to see the movie on Disney Plus, then people will say, well, why not just go to a movie theater? Which I think they're kind of doing that on purpose in order to save themselves when the movie theaters come back. I'm not saying that movie theaters will go away, but the same thing with like with Wall Street, the game has changed. There's a new process, so they need to find a new way to get people back into the movies. That's not just movies, because I'll give you an example. Down the street from where I live, there's a Frank's Theaters. I don't know if you have it there, but Frank's Theaters, they have great movie premieres, great movie seating, but they're also partially a bowling alley and a sports bar. And I see more people at the bowling alley and the sports bar in that one strip mall than I do people going into the movie theater.
Right.
But I do think movie theaters aren't going away. They just have to really change to meet the needs of the current society.
Right.
So Rob, I just put before you came on, I asked if anybody had been contacted by Rob Collarina with an invite to a really, really great event 10 minutes before it starts. So if you could, here's one tool to people to share their, or if you're speaking like Sarah, just putting that out there, or even Jonah sees a really cool event. If you put it on here, you can post it, we'll put it on here. Either way, we're going to cross market it so that everybody knows about things that are happening.
Hey Mark, are we going to do the cyber and security? And I just signed up for a company called Global Guardian, and I can probably get some good discounts for other companies, but they're for travel, like security and health emergency, and they have like updates on what's going on around the country. But there's a lot of new technologies out there for cybersecurity, protecting your computers, background, all the stuff that people should start to really think about, especially in a business, especially all this stuff going on.
Agreed. Look, it's 12 o'clock, and I know some people have to leave, and I've actually, wouldn't be surprised. I have a 12 o'clock that's on the Zoom, but I don't see them. But this is good. And good point, Ken, on cybersecurity. We're just trying to keep track of it. And if anybody has any, but again, just a reminder, on Wednesdays, we're here again, 10 o'clock for strategic advisors, just to go through the mechanics, share best practices, so trying to help and effectively promote the talent to the community. And then 10:30 is like, to your point on cybersecurity, bring those people on at 10:30, let them, and we'll talk to them, get them involved.
Hey, Mark, they do have
10:30 today, tomorrow.
Yeah.
10:30 tomorrow. Okay.
They do have an ATM. They do have a live ATM.
And I gotta go, guys. Take care.
So I don't know how people figure that into their calculus, but that's interesting.
I'm sure the SEC is probably going to be talking to them as well. But there's no limit on, when you have an ATM in place, it's good for 3 years, and there's no limit on how much you do when you do it. So
that's right.
Anyway.
Interesting points. Yep. All right. So again, tomorrow the conversations continue, and then but if you have, Rob, I got your name up here with some others to talk about Biden agenda. Different. We have the tax angle, may not always just be strictly tax, but that's Chris Tamura is coming tomorrow from Gibson Dunn, and I think Mike. We talked about fintech, some of those aspects, getting some critical views. It's not all rosy in crypto land, so we'll try to. But my 12 o'clock is now coming, which I can always move myself to another room. but lively as always. I knew it would. We knew it would be, right, Steven?
Yes, we did.
Okay.
And great feedback from Jonah and Greg and Will and others, Zach. Really good perspectives. You know, it's what makes a market.
Yep. All right, everybody. Thank you.
Thank you. Take care.
All right, thank you.